Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Mark Cudmore. We're an hour away from the opening trade. Here's what you need to know. Donald Trump threatens 100% levies on Russia, giving the Kremlin 50 days to end the war in Ukraine. Meanwhile, the EU firms up the list of US goods it could tariff if talks don't deliver a deal. Nvidia says it's resuming sales of its H20 AI semiconductors to China after the Trump administration apparently U-turns on restrictions. Plus, Japanese 10-year yields climb while treasuries hold firm, all ahead of US inflation data today.
In the meantime, a quick check on these markets here. Euro Stoxx 50 futures higher by 0.4%. The FTSE 100 lagging, underperforming just a little bit. We'll see if that reverses, of course, at the opening trade. One eye, as Anna mentioned, on that Japanese market. Dollar-yen is at a 147 handle. But to me, what caught my eye was Bitcoin. We are now at 117,000. It's risk on around the world. And yet, this momentum-driven cryptocurrency is down on the day. The countdown to the opening trade starts right now.
We're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there.
Good morning, everybody. This is the opening trade. Important new information then on the US relationship with Russia this morning, and that's certainly where we will start our agenda conversation. But before we get into the details of what we heard from the US administration on its evolving thought process around Russia, let's say good morning to Mark Cudmore, who joins us around the desk this morning. So executive editor for Markets Live, of course, usually with us in Singapore, but spending the week in London. How does it feel? It's early.
I love it. I'm excited to be here, to be back on the show with you both. So this is fantastic.
No coffee just yet. We'll make sure that's coming. Let us get to our agenda then. And, Kriti, we need to start with the Russia story, don't we? Because this is really interesting, the way that the US team's thinking, or President Trump's thinking, perhaps, is evolving around Russia. He says he's impatient. He wants Russia to change course on Ukraine. So he's threatening severe tariffs. He's also talking about sending weapons, which he says the US won't pay for, but Europe will. And this really takes us to this evolving thought process from the Trump administration. President Trump and Putin, they've talked many times, and Trump admitting he said he thought he was making progress. He thought there was going to be a peace deal 4 times around. So far, of course, elusive.
The vocabulary is getting intermingled with each other. We're talking about tariffs on Russia, despite very limited exposure to Russia from the United States economy as a function of a series of sanctions. But we're also using it interchangeably as secondary sanctions. And that's what he's talking about here. Not necessarily talking about, yes, 100% tariffs on Russia as well, which, again, would have limited impact, but 50% on people who work with Russia, notably China and India, that are basically buying oil from Russia for a discounted price. And it's that 50% on some of the largest economies of the world that causes some concern.
And also, it's meant to be the India trade deal that's meant to be signed soon. So surely that jeopardizes the India trade deal if he's going to suddenly punish them for trading with their biggest kind of energy partners. So.
Yeah, absolutely. And energy certainly to the fore when we saw these headlines drop. And it was interesting, Mark, that oil prices, though, didn't spike on this. They actually dropped because the market looking at it and saying, well, he's giving another 50 days to President Putin.
I know. It's another kind of threat where we don't actually know it's going to come in place. I mean, this time, it's not only the timeline that it might be backed out from later on, it's the fact that we don't really understand what he intends to impose.
Yes, to Kriti's point, we don't even know the title, the name of this.
Exactly.
Yeah, is it a tariff? Is it a sanction? What are we calling it here?
It's very vague. And, of course, the backdrop for oil is that there's still a lot of supply waiting on the sidelines to come on whenever we get a spike in prices. We saw that with the Middle East kind of tension over the last month or two. So that's the backdrop. And
if that's vague, we should go to chip export regulations out of the United States. Because, Kriti, we've heard from Nvidia what they think is happening, but we haven't actually had any confirmation from the US administration about this.
A complete 180 when it comes to what Nvidia is claiming is the new policy on these H20 chips. We should mention this is a big deal. This was one of the big key concerns around this was the idea that these chips had artificial intelligence capabilities that were ultimately being used potentially for Chinese cybersecurity firms, Chinese military, et cetera. And that was where the concern, not just under the Trump administration line, but under the Biden administration as well. From a stock market perspective, Nvidia is the world's most valuable company. It gets about 13% of its revenue from mainland China and Hong Kong. This is a big deal. And every time we've seen this kind of policy turn around, we have seen the stock react, and we have seen the broader market react, given just how exposed it is to Nvidia.
I think it's another tailwind for stocks this week. We've already got a low bar for earnings, so I think stocks still have that kind of general tailwind to kind of keep on, making fresh records in the short term at least. I do think on the Nvidia story it's interesting because one of the conclusions of all this tariff context is in China one of the big winners of these trade wars. It seems to be, we're getting punishing EU, we're punishing Canada, we're punishing Mexico, but it seems like China, the negotiations are going much better there. That's probably a little bit of a glib takeaway, but the other thing is maybe the US administration is realizing that these Nvidia kind of sanctions on China, there's no point anymore because China is catching up on the chip side.
Yeah, and this is what we've heard from Jensen Huang, the CEO of Nvidia. He's been saying, that all we're doing here is creating space for Chinese rivals. You're not letting Nvidia compete in China. You're not letting the American product into China. And so as a result, you're just getting China catching up more quickly. And that would be his argument, of course. Interesting, we saw NASDAQ futures spike on this then. So there was a little bit of upside move and some of the Chinese tech stocks moved higher on this, but actually paired some of those gains as if this was a sort of short burst of enthusiasm. We also got data out of China, Mark, that came in kind of mixed, I suppose, against expectations. Some weakness still in the retail spending side.
Yeah, I think the high-frequency data was a bit lower. Obviously, GDP beat. I think that there's been a lot of domestic spending, as well as, of course, the trade boom as people front load on tariffs. Of course, the much more exciting data coming out of the US later on today is the CPI. I think this is going to be, on one level, it's going to be quite anticlimactic because I don't think that it's going to clarify the story of whether tariffs will ultimately be fully passed on to consumers yet. I think it's still way too early to get the tariff impact. I know. But on the flip side, so that while it's going to be anticlimactic and kind of not really the big macro point in that regard, on the other side, I think it's really, really exciting because I think, and maybe Kriti will disagree with me here, I think that for the last 5-6 months, the real macro trade has been the dollar, obviously. I think perhaps we're getting to the stage where the next macro trade is going to be the long-end bond yields. And I think that's what we're seeing really, really kind of exciting. We're seeing, 30-year yields around the world kind of creep higher consistently. And they've got two factors there. We've got the fact that we're at the end of the disinflation phase. We're about to get more tariff inflation coming through at some point in the coming months to some level. And we've also got the fiscal situation as well. So I think that maybe bond yields becomes the exciting story the next couple of months.
No, I think it's a fair point. And I think the CPI story, again, we talk about complacency to a lot of these tariff headlines. So that hasn't showed up in the hard data yet. There's a little bit of complacency when it comes to CPI and any other sentiment or consumer sentiment gauges as well, because there is a tendency by this market to look through it. So if hypothetically we get a hot CPI print today or a super, super low one, it'll be kind of taken off as, oh, well, it's a one print, therefore we're not trading it.
Yeah, I mean, what is the timing then on when we get this pass-through effect? We've talked about this a lot on the programme. We talked about, guests coming on and saying, look, this will hit CPI at some point, but we just have no idea what eventually means.
I think it's a really long-term story. I don't think there's one data point, because I think the whole point is we've got so much uncertainty that a lot of companies are trying to hold the line until they find out what we're eventually going to get in tariffs, which means all companies are going to be doing it at different levels, and there's going to be different kind of rates of supply chain pass-through. So I think this is going to be a creeping story over the next year. There's not going to be suddenly one print that seals the deal. Of course, at one point, we might get a tipping point where we're like, oh, there's real inflation now. But that will only be the start of that story rather than the binary point in that story.
OK, an excellent conversation to be had then with Nicola Mai, who's going to be one of the guests joining us today to talk about the markets. Nicola Mai, PIMCO Portfolio Manager, will be with us. We'll be talking about global bond markets, European in particular, but certainly being influenced by these global factors. We'll also speak to Kei Jin, LSE Economics Professor and China expert. A lot to talk about when it comes to China then, with the data that we've had out from China overnight, and how China fits into the Russia oil, the tariffs, the sanctions story. China has been benefiting from buying some of that cheaper energy. Louise Dudley will be with us, Federated Hermes Global Equities Portfolio Manager. We will talk to Louise about all things UK equity markets and beyond. Nigel Wilson will also be with us, Canary Wharf Group Chairman, formerly of Legal & General, and a great person to speak to on the day, Kriti, that we get the Mansion House address from the Chancellor. A lot of UK financial services themes in focus as a result.
Absolutely, and plenty of data and earnings to keep us company throughout the day as well. 10 a.m. UK time, Euro area industrial production going to be hitting the wires as well. And then the focus kind of shifts to the United States. The U.S. bank earnings are going to be hitting as well. This one's interesting. JP Morgan's CEO, Jamie Dimon, has been very vocal about the fact that the tariff impact still has yet to come, still has yet to do its damage, really warning against the danger there. I wonder if we get a little bit more. Plus, of course, how those banks, JP Morgan, Wells Fargo, and Citi, are positioning in terms of loan loss provisions, investment banking revenue, where they're really putting their weight behind in their individual businesses. But as Mark said, the 1:30 p.m. UK time, that US CPI is the main event for today. Globally, at least for the bond market, I would argue we have two other things to keep an eye on. That is the French budget plan. That could shake the European bond market. And, of course, the Mansion House speech, which could shake the gilt market as well. two conversations that very much have to do with the budget, that have to do with changes in terms of France and the UK and how they can stay competitive.
Yeah, two conversations about fiscal restraint and about the limits on what you can do with your spending intentions and your spending priorities, certainly. In France, really interesting because, of course, we've seen this bring down governments in the past. We saw what happened in December, wasn't it, with Michel Barnier trying to bring forward his budget, and he was rounded on by the far left and the far right, united to get rid of him. We'll see whether the current Prime Minister has any better chance. But actually, the bond market's evolved a little bit, I think, in their thinking around the periphery and how that relates to France since we were last having all these conversations about France. Mark, your thoughts as we head into this budget?
When it comes to bond markets, as I said, I think that's where the vulnerability is globally. But obviously, we're more focused on the US and Japan at the moment, or UK. And in fact, in many ways, of major developed bond markets, EU countries tend to be doing better. But at some point, this is going to go global. Essentially, the move in treasury yields is kind of driving bond markets everywhere. And then when you start getting stress in Europe, it is, of course, France, which is now the weak link, not Italy. And I think that's where you're going to get the real pressure the next time it comes into Europe. That might be still quite a few months away, but it's something to keep an eye on.
Yeah, lots of people, I think last week we had a guest on saying Europe doesn't have a problem at all, because if you look at the cross-Europe numbers, the pan-European numbers supported by Germany, there's a lot of room to borrow, isn't there? But then the bond market, the issuance is by nationality still, and France has had issues like that.
Back in the Eurozone debt crisis, 14 years ago or 15 years ago, Europe also didn't have a problem in aggregate. But of course, it had a whole debt crisis because in country level. And I think, as I said, Greece is now a wonderfully stable bond market. It is France's the vulnerability.
OK, so lots to talk about when it comes to European bonds. We'll do that shortly. Here's what else you need to know then this morning. Officials from the European Union are to hold talks with Elon Musk's X after the company's Grok chatbot caused outrage by making anti-Semitic posts last week, including praising Adolf Hitler and the Holocaust. The company deleted the offending posts and apologised, blaming a faulty update. Volvo Cars says it's taken a $1.2 billion impairment charge because of delays to some of its electric models and the rising costs of tariffs. It says it will no longer be able to sell the ES90 sedan in the United States profitably because of the import taxes. Volvo Cars shares are down around a quarter this year. And UK Chancellor Rachel Reeves will deliver her Mansion House speech later today, outlining her vision for the future of Britain's financial services industry. The Chancellor is expected to highlight plans to spur home ownership by easing access to mortgages. Reeves has been under pressure since a U-turn over planned welfare reforms and an emotional showing in Parliament that caused traders to sell gilts and the pound.
In the meantime, coming up on the program, U.S. big banks kicking off earnings season. JP Morgan, Citigroup among today's earning releases. We're going to dive into what you can expect ahead of those reports. Speaking of reports, right here in Europe, Ericsson reporting a second quarter beat this morning. We're going to check in on the company's shares at the opening trade. But up next, we go right back to the bond market. Japanese 10-year yields hitting a 17-year high. We'll discuss possible read-across for European sovereign debt. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. Less than 45 minutes away from the opening trades across Europe. Futures looking fairly positive. The outperformer, of course, on the continent. And you are seeing the French index higher by about 0.3%. But the main event is later today in the United States. U.S. CPI, of course. Valerie Teitel is here with a preview.
Good morning, Kriti. Yes, the big one, U.S. CPI today out around 1:30 p.m. London time. We are expected to see a broad-based tick-up in inflation along core and headline, both year-on-year and month-on-month. But remember, this does follow on nearly 4 straight months of soft core CPI readings. The real key for today is if we start to see a broad-based inflation impact around core goods. We've had a laser focus on those tariff-induced sectors such as electronics, apparel, and furniture. But if inflation starts to broaden out past those specific components, it could be the first signs that retailers are becoming more comfortable passing more costs on to consumers, and maybe the beginnings of hints that inflation could be more persistent and broad-based than originally believed. So a hot print today could definitely dent the equity market enthusiasm we've seen this morning. The other thing that could dent the equity market rally is what we've seen going on in yields. U.S. 30-year yields have come very close to 5%. A lot of that due to what's what's going on in Japan. We've really seen JGBs falling out of bed for multiple mornings in a row. Overnight, we had not only the 30-year yield hit the highest it's ever seen since its debut in 1999, but we also had the 10-year yield hit the highest since 2008. And this is something new. We're starting to see the impacts on the other side of the curve. That 10-year sector is really important for the Japanese economy. A lot of mortgage products are tied to the 10-year sector, so it could have a real impact on GDP growth. A lot of this having to do with the fact that more fiscal spending is likely to be on the way. We do have those upper house elections this Sunday. But notably, it needs to be said that liquidity is also steeply deteriorating in JGBs. I've got a chart behind me. This is a Bloomberg index of liquidity. A higher number means liquidity is worsening. We've hit the worst liquidity we've ever seen in JGBs. This index does go back around 20 years. A lot of that has to do with the fact that even though we've had the Ministry of Finance issue less long-end bonds, we have the Bank of Japan change its tapering, we are still seeing pretty terrible liquidity conditions in JGBs. Anna.
Valerie, thank you very much. Bloomberg's Valerie Teitel with details on some of the things we're watching in the bond market. Certainly the CPI data is ahead. Lots to talk about when it comes to the French market, the French budget. But let us start by thinking about what clues we should get from what's been going on in Japan. Valerie was talking there about the movement we've seen in Japanese yields. Often we come in the morning and there are stories about Japanese yields going higher in the last few days, it feels. Let's talk to Nicola Mai, sovereign credit analyst at PIMCO, here with us on set this morning. Nicola, very nice to have you with us. So what should we be taking our signal from Japan? Is there some read across that's useful? Because often about 7:35 in the morning I see headlines that suggest, Europe took its lead from Japan and yields went higher. What read across should we be getting here?
Well, I think the market is trading a lot on fiscal news. I think there are concerns. Public debt levels are very high. In Japan, they're among the highest in the world. And the curves have been steepening on that, higher issuance, fiscal concerns, debt sustainability. And I think it is a global phenomenon. And so the markets where fiscal is judged to be weakest are the ones that are suffering more. And I think, Japan, especially with a potential upper house election where a VAT cut is flagged and where potentially the fiscal concerns could increase, is an example. But this is not the only country. I think the curves have been steepening everywhere.
Yes, the timing of the election makes things particularly focused, I suppose, in Japan right now. But here in Europe, then, where is the area that you worry about? We've got a French budget announcement. Is it France again? Are we back to worrying about France a bit here in Europe?
I think France is particularly concerning in the Eurozone because if you look at the debt to GDP dynamics, the US, Belgium and France have the steepest increases in debt to the GDP going forward. And I think France will have to, at some point, consolidate. We know it's quite hard in France to push spending cuts. The tax to GDP ratio is already quite high. I think the government will have to do something. I think this week we'll only see some ideas flagged. But I think in autumn is where the rubber meets the road. And I think the government will probably have to implement some austerity. So I think France is certainly a place to watch.
Nicola, good morning.
Good morning.
I know you're bearish France on a relative basis, but overall you're kind of quite bullish duration still. It's not been a great this year for duration, despite low growth. What do you think is the catalyst for markets to suddenly start playing that slower growth story rather than the ongoing concern around fiscal tariffs? Like, what is the change in the narrative? Because to me, I worry that the fiscal nervousness is going to get worse in the coming weeks.
Yeah, I think the first point I would make is when you take duration risk, we'd rather take it in the sort of 5-year part of the curve, the belly of the curve, which is more anchored by the view that equilibrium interest rates in our mind remain low. We are quite cautious the long end of the curve, the 30 years. I think those fiscal concerns are not going to go away. I think the appetite for central banks to do QE, quantitative easing, is lower because they saw how much it actually costed once interest rates rose. But the sort of belly of the curve should be anchored. And I think what is going to get duration to perform better is when the economic weakness is going to be more evident. I think in the first half of the year, the global economy did okay, but there was a lot of import front loading in advance of tariffs. I think as we move forward, that weakness will become more evident.
So almost like a bullish steepening rather than a bear steepening we've kind of seen to some extent. But are you not worried that if we get to a certain level at the long end, we start getting a bit of a panic? We saw that chart just there from Valerie about Japanese bond liquidity at the worst even since the crisis. We've got 30-year going up close to the 18-year highs. It's only 20 basis points away. Are you not worried that, that there just becomes this self-fulfilling narrative around debt? In the same way that we had the Eurozone debt crisis 14 years ago, it becomes a spiral. And therefore that might, also hurt the front end a little bit as well. Not knowing the very front end, but 5-year could be vulnerable.
I actually sort of feel that the long end yields are, in a way, their worst enemy, and that they tend to be self-correcting at some point. Okay. In that if the U.S. yields in the U.S. go up a lot, as we know, mortgages in the U.S. are based on very long-term rates, so the long end of the curve does affect the economy. So there will be a point, there is a point when the rise in yields generates, expectations of economic weakness, which actually leads to a correction down. And I think we shouldn't be far from that point.
When you talk about, I'm going to bring it back to the housing crisis, or thought of a housing crisis, I should say, that might be moving the curve. There's a question specifically in the States that you're already seeing some of the second-tier cities see that kind of crash. How dangerous is that for the thinking at the Federal Reserve, or even how quickly could it show up in things like CPI?
Well, I think that the housing the state of the household sector in the U.S. is much more healthy than it was before Lehman Brothers. So I think households have deleveraged a lot. They're in a much better financial position. The pass-through of interest rates is still quite gradual because many people locked in mortgages at very low rates, post-pandemic. So I think we're going to see some weakness, but that's part of the pass-through of monetary policy. I mean, we've seen higher interest rates, steeper curves, and that is partly what will get the U.S. economy to slow and what should enable, Fed cuts going forward, despite some initial caution because of the tariff-induced inflation hump.
Can you talk to us about the ripple effect then on the deficit side? If we hit that X date in late August or early September or whenever it is that we're supposed to hit it, what does doomsday look like in the U.S.?
Look, the U.S. has the exorbitant privilege of being the reserve currency of the world, and I think that privilege is not going anywhere. We do see the dollar weakening on a trend basis potentially going forward, but that privilege will probably remain in place. So based on the recent fiscal news, I think the U.S. deficit will stay in the 6 to 7% area, which means that debt to GDP will keep increasing. That should raise the term premium, steepen the curve as it's happening. But do I see a big sovereign crisis in the U.S.? Probably no time soon, because I do think that this reserve currency status buys the U.S. time.
Where do you stand on gilts right now, Nicola? We saw actually that various UK assets benefited a little at the margin from the drama around the fact that the EU doesn't have a trade deal yet. The UK has a trade deal. I mean, I was going to say that's about the only area of certainty. There's lots of other areas of uncertainty, but even the trade deal isn't a full trade deal, so there's plenty of uncertainty there. So where do you stand on gilts, all that said?
Look, gilts, they're among our favorite duration exposures. It's been a very volatile market. Fiscal news have been very mixed, to say the least. But I would say that there are a few points that make me quite confident that UK duration can perform. The first one is the labor market. I mean, we're seeing employment contractions. We'll see what the report is this week. But the labor market is clearly very weak. Wages remain high, but the surveys are pointing downwards. Core inflation has been boosted recently by tax and regulatory price increases, but we do see on a forward-looking basis quite a slowdown in inflation. And I think the fiscal tightening is coming. In the autumn, the budget will probably be quite painful, and I think all of that should lead the Bank of England to cut more than what the market is pricing.
All right, Nicola Mai, sovereign credit analyst over at PIMCO, with a little tour of the bond story around the world. We thank you so much. Coming up, we go to China next. China's GDP growth coming in better than expected, but the consumer still under pressure. We're going to break it down with Ki Jin from LSE. This is Bloomberg.
Welcome back, everybody. 30 minutes until the start of equity trading here in Europe, so 7:30 here in London. It is Tuesday, the 15th of July. Let's have a look at the futures picture. A few reasons to be cheerful. One of them is the Nvidia story this morning, certainly sending Nasdaq futures higher, up by 0.5%. Some Chinese tech stocks doing well on the back of that, so we'll watch to see if that has any read across into Europe. We'll also watch house builders here in the UK. Lots of talk about what might be done around mortgage policy in the UK, Kriti. So a few reasons why stocks could go higher at the start of trade.
Absolutely. We'll see if any of that shakes out in about 30 minutes' time. In the meantime, the bond market is very interesting. We're seeing 442 on the U.S. 10-year and a slight bid into bonds across the continent as well. German 10-year down about, we'll call it 2 basis points. The Italian 10-year as well. But I think what we're really watching for is any sort of reaction in the French 10-year, specifically ahead of the speech from Prime Minister Bayrou later today. He has to explain how Emmanuel Macron is going to speed up defense spending, doubling it by 2027 instead of 2030, and where that money is going to come from.
Yeah, where all the money's going to come from. How are they going to bring down the deficit then in 2026? That's certainly going to be a focus. Interesting then, talking to Nicola Mai from PIMCO, he was, if there's concern anywhere in Europe, it is around France. It does seem to be around the sustainability, the fiscal sustainability story. When it lands in Europe, seems to focus on France, and so that's what we're alert for.
Yeah, absolutely, but it's not going to be today. Like today, right now, just eyes aren't on the European bond market. They're on this French story, the budget story. They care about that because they know long-term that's where the pressure is going to be in Europe. But we're going to wait for, basically, Europe's a lower beta story on the duration story. It's going to be vulnerable as treasuries sell off, as JGBs sell off to some extent, but not for a while yet. So this is kind of, we care about today because it's an incremental margin, but it's not going to be traded aggressively in the short term. OK,
so things to think about when it comes to France, even if the market doesn't move on it in the next 24 hours. Let's talk about what's going on at the European level, the latest tariff news lines for Europe. So the European Union has finalised a list of countermeasures to target US goods worth 72 billion euros, including cars, bourbon and Boeing aircraft. The suite of measures represents the EU's response to President Donald Trump's earlier so-called reciprocal tariffs, the ones that were announced on so-called Liberation Day. For more, Bloomberg's Brussels bureau chief, Suzanne Lynch, joins us. Suzanne, help us unpack the latest news lines here and what matters. The names of the companies, or rather the names of the products that are going to be targeted here, perhaps not all that new. We were told previously they were talking about cars and drinks and aircraft. But actually the number, the sort of sticker price, I suppose, if that's the right word for it, has come down on this. So Europe actually talking about a smaller range of goods than previously if they were to retaliate, and that's an if. So what does this mean, this story around European retaliation this morning?
Yes, you're absolutely right in all that. I mean, it has come down. Initially, they had been targeting goods worth 95 billion. That has been whittled down to more like about 72 billion. And what's been happening here is that this conversation started a couple of months ago here in Brussels. And this was about the European Commission talking to countries, talking to companies about what goods they should hit in the event that they want to retaliate. So as you can imagine, there was a lot of lobbying by different countries who wanted to protect the industries in their countries. There was a lot of lobbying by companies as well. And this is where we landed. Bloomberg got this document very late last night here in Brussels. It was presented to member states, and it does outline the kind of products that will be hit. And again, if the EU decides to retaliate. So up there is aircraft. That's a big part of this, about 11 billion or so. Also cars, we've got bourbon, some of those US products that we've heard about for a long time before, and industrials and chemicals. So that's where we are with that list now. What we do know, though, is that this is not going to be invoked anytime soon. What we've been hearing from the EU over the last 24, 48 hours is that even though they were taken aback and not happy about the escalation by Trump over the weekend, where he threatened 30% on tariffs, they're not going to act now. They're going to try and get these negotiations back on track to try and get some kind of provisional deal by this new deadline of August 1st that Donald Trump has set.
Suzanne, it's interesting when you go through the nitty-gritty of this list that they've actually prepared. I mean, the Boeing aircraft story we've known for quite some time, and that would be an easy one for them to target. But the idea that they're pulling back on some of the drink makers specifically and the drink export specifically, or excuse me, I should say increasing the drink export specifically despite the lobbying from the French, I thought was interesting. Suzanne, there's also a question here about the timing, because if I understand it correctly, the retaliatory tariffs, if they do end up kick in 5 days after U.S. tariff due. Can you explain why that delay?
Yes, so this is what they're working towards in terms of trying to get that sign in, because even if the European Commission decides this, there is a complex process here. Member states have to agree. So they're now looking at that 6th of August deadline to give them that bit of wiggle room. I mean, they are very confident here that this August 1st deadline will be met. We are hearing this from all levels of the European Commission, right down from European Commission President Ursula von der Leyen on Sunday, who is very strong in saying this. Also, Maros Sefcovic, we know he's the top trade commissioner. There are going to be contacts going on with the US all week on this. So they believe there's a deal to be done. They believe that they do have leverage here, that even as well as this list we're just discussing, there are also other means that the EU could use. So they could anti-coercion instrument. It's very technical, but it's the EU's big trade. It's a big trade instrument it has. So there are other options too that the EU can invoke if this really escalates. But at the moment, they're still hoping for a deal.
We thought we'd lost you for a moment there, Suzanne, but you came back, so that was a relief. Thank you very much. Bloomberg's Brussels bureau chief Suzanne Lynch with the latest on the European tariff stories. And President Trump, yes, himself saying, I sent a letter to Europe, that's the deal done, but Europe wants to talk, Europe's coming, they're going to talk to us. So we'll see what can be done by the beginning of August. Let's go from the tariff story to a bit of corporate news we have out this morning. This coming from the mining sector. Rio Tinto has named a new boss. They're naming Simon Trott as the new CEO. So Jakob Strauss-Holm, who's somebody who's talked to the programme on a number of occasions, will be stepping down as CEO and from the board. They're naming Simon Trott as the miners' new CEO. He's 50. He's taking on this role after Rio apparently is seeking a leader with more mining experience, trying to maintain portfolio growth around the mining space. Rio has many expansions in the pipeline, including a $13 billion splurge on iron ore, a range of new lithium projects, and plans to keep growing in copper. So lots to think about when it comes to Rio Tinto. Of course, Rio Tinto has been trading in Australia. This is the picture over on the Australian share as it stands right now, down by 1.3%. Is that open? Hasn't moved as I've been talking. But anyway, that's what's happening down in Australia. In 23 minutes' time, we will have the opening price in London, so we'll bring that to you.
Absolutely. You mentioned that key piece there. Their plans to keep growing in copper. So naturally, they have one eye on China as well, I think, as we all do. There's been a big question here about the tariff story, how that continues to ripple as Donald Trump thinks about secondary sanctions, or tariffs, as he calls them, on Russia, what the impact of that is to China. One of the conversations we've been having around this table is China impacted at all? If you look at the data today, things seem to be just fine. Let's get a little bit more analysis this morning. Kyu Jin, professor of economics at the London School of Economics, joins us this morning. Kyu, a pleasure to have you on the program. Talk to us about why China isn't seeing a bigger hit despite escalation from Washington and arguably escalation from Brussels as well.
Well, first of all, there's a big discrepancy from what we know from the macro numbers and the micro level. Macro numbers could beat estimates, they could achieve targets, but on the micro level, things are still looking pretty bleak. Lack of confidence, certainly the front loading of exports, the building, the warehousing, front running some of these tariffs are the reason why we've seen pretty okay export numbers. But it belies the fact that there's really an involution competition going on in China of price wars, and I think the impact will be seen over time. However, Chinese companies are strategically pivoting. They have been preparing for this for many, many years.
When it comes to that kind of preparation that they have for many, many years, can you just walk us through some of the things that might cushion the economy from any sort of further escalation from Washington?
Well, of course, the focus is all about internal demand. It is about time. If we look at the policies in the last couple of decades, really, it's all been about supply. The local government political economy model is all about building national champions, the likes of DeepSeek, which of course earns a lot of political points. A lot of the resources not really incentivized to direct towards consumers, like building Social Security and really doing the proper rural reforms. This is why consumption has been persistently low. Now there's a real sense in which policies are focused less away from supply and more towards consumption. But really, we've seen some positive numbers of consumption after the stimulus package, but they don't have really quite the internal endogenous energy to persist. And this is because of still decelerating household income and lowering corporate income and profits.
Good morning, Kyu. I think 48 hours ago, I'd never heard of the word involution, and now I feel like in the China conversation, I've heard it about 10 times in the last 48 hours. But I just wanted to ask you, I feel like the story on China has not really changed much in a couple of years now. It keeps on being incremental, we keep on hearing that they're doing more measures to kind of stimulate the domestic economy, to kind of swivel, but the growth, the deflationary problems still remain very, very strong, and therefore we're not really fixing the underlying problem, but there's incremental change. But it does seem like the narrative from global investors is changing, and even domestically they're becoming a bit more positivity. Is there a chance that just because the narrative's changing, that starts stimulating some animal spirits, and that we can actually get some traction from these measures, even if they're not theoretically game-changing on the at a headline level?
Well, absolutely. Apart from the dichotomy between the micro and macro, I'd say there's also another dichotomy, which is, despite economic weakness, a very dynamic, entrepreneurial, innovative ecosystem. The DeepSeek movement is really only in a beginning. If you look at robotics and a lot of high-tech sectors, again, this is really reflecting a policy shift as well, going from traditional old manufacturing industry to new productive forces, high-tech industry, really a focus on that. But look, the truth is, this is not going to displace real estate in terms of GDP contribution and employment. So whilst China is in this transition, weaning itself off of property and old industries, there will be substantial pain along the way.
And in Asia, amongst China's major trade partners, where are we seeing the biggest beneficiaries on a country level and biggest kind of people suffering from China's change in its supply chains as it deals with kind of US trade tensions? So who's winning in Asia? Who's suffering from what China is changing?
Well, the truth of the fact is, in terms of trade, not technology, but trade, there's an illusion that there's decoupling between U.S. and China. That's not the case at all. The U.S. supplies, imports of goods embody a substantial amount of Chinese goods, and more as China produces more intermediate goods that could be flowing from the likes of Vietnam and Mexico, now increasingly from Malaysia and from Europe. And in fact, the U.S.'s biggest imports happen to be the countries that China have exported more in the last few years. So they're actually really deeply embedded with each other. But really, the strategy currently for the government, but also for Chinese companies, is regionalization. Regionalized supply chain, local cutting-edge technology, and really a arrangement of global supply chains. But still, U.S. is still importing, finally, a lot of Chinese goods.
Kyiv, can I ask you about the relationship between China and the oil price? Even this morning, we see Kaja Kallas, the EU Foreign Affairs Chief, doubling down on Europe's commitment to try and change the price cap that Europe has in place and the US has in place when it comes to global oil shipments and Russian oil in particular, and not allowing Russia to make too much money out of its oil industry. How much has China benefited from that policy? China, therefore, able to go out into the market and buy cheaper energy?
To be honest, China sees energy as a prime national security issues, along with food and critical resources and minerals and so forth. So it does factor in very much into the consideration. Relationship with Russia, as China is well aware, is a very sensitive issue. It has to tread this line very, very carefully. So in terms of how much actual indirect or direct benefit, it is hard to argue. But if you look at Chinese EV penetration, this is going to be above 60% this year and next year. China is really fully going green. And again, it is about one word: self-reliance. Self-reliance, less reliance on energy, less reliance on critical technologies. And this is a strategic, this is a prominent strategic direction.
OK, thank you very much, Professor of Economics at the London School of Economics. Kyiv Jin, thank you for joining us, talking about all things China. Coming up on the programme, we look at Ericsson shares after the company's profit beat analyst expectations. This and other stocks that we're watching this morning. That's next. This is Bloomberg.
Just over 12 minutes to the opening trade right across here in London and across Europe as well. But there's one chart that I really want to put forward to everyone's attention, and it really has a lot to do with the tech space. These are a series of charts that caught my eye, and I think it's really important because, of course, Nvidia is in today's headline talking about really having a game-changing policy when it comes to whether or not they can export their H20 chips to China. This is a really big deal because when we talk about it from a regional perspective, you get about 13% of exports of revenue to China and Hong Kong. And that's going to be crucial for Nvidia's bottom line. We've seen that stock really trade on it. But when we talk about that China exposure for a mega cap tech company, and of course, one of the largest, the most valuable company in the world, it brings me back to another tech stock that used to be the world's most valuable company in the world, at least publicly traded. And that's Apple. And this is really where I want to kind of make a little bit of a connection here, because this is one of my favorite charts. I think it's a little less relevant now, but historically, it's really held true. Every time Apple Apple has hit its $1 trillion mark in the market cap, 1 trillion, 2 trillion, 3 trillion. It hasn't hit the 4 trillion yet. That's Nvidia's to take. You've seen a massive sell-off, not only in the stock, but in the broader S&P 500 as well. And it goes all the way back to 2018. That's where these green dots really show, followed by a 10 or 20% level, which really tells that the market gets overheated, gets really questionable about valuations. And there really is an Apple story, because at the end of the day, this is a company that has a lot of exposure to China, to India, of course, but also to the end consumer in the United States, not just from actually selling the hardware, but from things like services. Plenty of people go in to get their Apple phones tweaked at the Genius Bar. That itself, that services revenue, is 30% of their bottom line. So that's why a stock like that or a chart like that was really significant. Does it apply to the new king of tech? And that, of course, is Nvidia. And my research by this chart suggests no, it doesn't. Every time Nvidia hits that $1 trillion mark, you don't see that same sort of pullback, that same sort of correction, not even in Nvidia stock, and certainly not in the broader market. You see the opposite. You see a floor that is actually built out from underneath the stock. And it happens every single time it hits that $1 trillion market cap. And I guess the question I'm posing out to the universe is, why is Nvidia different from Apple?
Kriti, I was hoping you'd answer that question. I thought that was the whole point. You were going to throw questions at us. I had two questions to ask. Do we know on the Apple chart whether if it keeps on hitting those, selling off after it hits those $1 trillion levels, do we think that's just a psychological thing, or do you think it's about option trades are set at that level, and so therefore once you cleared all the options, there's actually reason to then sell afterwards? I.e., do we think there's actually a technical reason for the sell-off afterwards, or do you think it's purely psychological? And because you may not have the answer to that question immediately off the top of your head, but I'm curious in your thoughts. I have one other question. I feel like Nvidia and AI is really driving the stock market again. Like the whole AI story, we've seen Korean stocks outperform, we've seen Taiwan again doing really well. Since Liberation Day, we've really seen AI really drive the stock market, except no one's talking about it this year at all. Are we missing a trick on... Should we be paying more attention to the AI theme again?
Let me give you all the answers here, Mark.
Brilliant.
Maybe I can. I'll start with the Apple question as well, because you're right. It is actually have to do with some of the options positioning as well. But if you think about it, go back in history and talk about some of the sentiment around these moments. Back in 2018 and even arguably into 2020, ahead of COVID, there's a big concern about valuations in the tech market. And yes, that has been something we've talked about for years. We're even having that conversation now. But that was very, very true back then. There was also a rates component to this as well. And every time you just needed that kind of catalyst to kick off a broader fear. And that's why I think it's important that it wasn't just a pullback. It was a 10 to 20% correction in the broader market, not just Apple, which I think, to your point, capitalizes on those fears. To Nvidia, to your other question, I think that's a really crucial one as well, because the AI story seems to be a longer-term trajectory, a broader theme in the world, whereas Apple, I don't know how well you can extrapolate the business case there.
I like the way, Kriti, that you pose questions to the universe and Mark answers. I don't know if this is everybody's dream scenario or everybody's worst nightmare, but either way, we now get to put Mark on the spot with 3 minutes on the markets for the Markets Live, from the Markets Live perspective. And we started this programme talking about CPI, big market event of the day, I suppose, although you rained on it slightly, Mark, by telling us it's not going to move things perhaps today. What are we going to be watching for? It's all about the dollar for you. Yeah,
it is about the dollar. But I'm going to take a few seconds of my time just to push back. Worst nightmare is a little bit harsh. And I actually didn't answer Kriti's question. I just threw it back at her. On the dollar, I think the reason is today on CPI, I think that ultimately, not in the short term, but over the next week or two, whatever we get today is going to weigh on the dollar, because the bigger kind of context for this CPI print today is the pressure on the Fed from the administration. And so if we get a soft print, well, then the pressure on Powell will absolutely double down and go extreme, and we'll really see that front end really move lower. If we get a high print, then, sure, short term we might see yields bounce, dollar bounce, a bit of a squeeze, risk version. But then everyone's going to go, there's still pressure on the Powell to cut rates, despite the fact that we're seeing that inflation come through. So either way, the backdrop story here is that the Fed is being pressured to have too easy policy relative to what inflation should justify, and that's bad for the dollar.
Sounds like the Fed's not independent.
The Fed is not independent, and that is the problem for the dollar. And that's why I think, a lot of what I'm hearing in the market at the moment for the last couple of months is constantly people trying to buy the dollar bottom, catching that falling knife, and can constantly predict a dollar rebound. I just don't see any dollar rebound getting any real legs. I mean, there can be short-term ones, but, we've been having a massive debate over the last week or two on the team about where euro-dollar can pull back to. And I'm just like, I don't see euro-dollar getting to 115 because the whole world is waiting to buy it below there. So I think, any squeeze in the dollar just is going to be faded so quickly.
What is the swing back risk here? Because I think 6 months ago we were talking about parity on euro dollar. There's a question here of if there is such a consensus kind of short dollar trade at the moment, and you do see that knee-jerk reaction, what does that look like? What's the floor on that? I
don't think it goes far in terms of that kind of rebound, because what happened is in the positioning, and you know, a lot of the positioning metrics are not perfect, but you take the CFTC positioning as one kind of guide. We've gone from extreme longs in the kind of the market that tracks to shorts. Now, the largest short in several years, but it's still not very short. But the bigger picture is reserve managers, the world is overexposed to the dollar still because people bought US stocks unhedged on the FX side. So there's still a lot of dollar selling to meet any kind of rebound, and that's why I don't think it goes very far.
Stocks, earnings season is upon us, Mark.
Yeah.
Does that cut through before tariffs really cut through?
I think that's the bigger driver right now. Because no one knows what ultimately gets implemented on tariffs, we're going to push playing the tariff story much closer to the deadline. So I think the short-term story is, you know, we talked about it the last week or two, you know, even as we approach the initial July 9th deadline. I think, you know, that the tailwind is, fiscal tailwind is positive. Macro data is good. I think it's short-term bullish, not major gains. I think it's going to be a rocky kind of gains, but I expect stocks to be higher again a week from now. Earnings will probably help that story because of the low bar. So I think the short-term picture is bullish for stocks, but I think we're probably getting towards the more difficult territory, and by August we'll probably see stocks weaken again, I think.
Certainly not the story for today, but we'll see how that goes. Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you so much. It's the opening trade across Europe next. Futures are in the green. Stick with us. This is Bloomberg. It's a morning of 180s, it feels like, from Washington, but I feel like that's what showed up in the market reaction yesterday's session, because 24 hours ago, I was right here talking about how futures were in decline. A lot of reaction to that 30% tariff from Donald Trump onto the EU, and that's where the day started 24 hours ago, only to get better from there. This idea there was a softening in the tone from Donald Trump, something that carried not only the Stock 600 into positive territory, but the S&P 500 into positive territory as well. And it feels like the party continues today when you look at the futures picture. Perhaps a change in tone when it comes to Donald Trump's policy around H20 chips into China. Does that create some sort of thaw when it comes to the relationship between the two largest economic superpowers in the world? Nevertheless, one eye, of course, on what's going on in continental Europe. DAX futures higher by 0.2%. The CAC Iran higher as well, Anna.
Yeah, absolutely. So we'll watch out if we get any read across from that Nvidia H20 Chips story into European tech. We're also going to be watching these names, Kriti. Ericsson in focus, the maker of telecoms equipment, of course. Profit beating expectations. US sales growth boosting the market for 5G telecom equipment in the second quarter. So that seems to be a positive story coming through at Ericsson. Rio Tinto also in focus after they name a new CEO. So Simon Trott, who's the head of the iron ore unit currently over at Rio Tinto, is going to be taking over as the new CEO, replacing the outgoing Jakob Stausholm. So we'll certainly watch to see if we get any response in the Rio Tinto share price. And Volvo Cars in focus as well. They're taking an impairment charge of 11.4 billion Swedish krona. That's about 1.2 billion US dollars due to delays in some of his electric models and, crucially, Kriti, talking the T word, escalating costs of tariffs.
Well, does that T word actually have any impact on today's market session? As I said, we did see a complete 180 in that picture from yesterday. Let's take it to the test. This is, of course, the opening trade across Europe. The FTSE 100 kind of flat at the opening bell, or opening trade, I should say, of Europe. I think what's really interesting for me specifically today is going to be that tech exposure. Do we see a move in ASML? Do we see a move in SAP off of that Nvidia story, and really that softening that you see from the United States into China, at least according to Nvidia? The Stock 600 opening flat as well. Slight outperformance from the FTSE 100. Now we just wait for the French index, and that's going to be a crucial one ahead of the budget that Prime Minister Bayrou is putting forward, higher by 0.1%. Again, this is not the high-flying start to the open, Anna, that we saw from futures, but maybe that changes as things shake out.
Yeah, we'll see how this evolves this session. And as you point out, yesterday's session certainly evolved. You had the initial shock around those Trump headlines, and then it evolved to something a little bit more positive, or at least resigned to tariff headlines. Let's have a look at the sector breakdown then, and we've got banks to the top of the sector board. So the banking sector is the best performer. Oh, sorry, that's just changed. Travel and leisure also doing pretty well. Oil prices continue to retreat, 68.82, so perhaps that's having an impact on the travel and leisure space. Technology is a strong performer this morning, up by 0.5%, and that's easy to link to the Nvidia story, to H20, the ability to ship those chips to China. No direct read across perhaps to European tech, but anything that supplies Nvidia, anything that supplies that AI machine, perhaps liable to do well today. And telecoms is the worst performing stock today. And I'm looking for what's happening to Ericsson. Yes, and that stock is down by 2.5%, despite the fact that the numbers seem to come in better than had been anticipated. So that's a big mover there.
Absolutely. Some fascinating ones as we look across this kind of market today, because we're not seeing a ton of major action this morning. I think the ASML story is probably the clearest read-through we get from Nvidia this morning, higher by 1.6%. And I think seeing probably the most volume they've seen around everywhere else. L'Oreal, however, is your biggest downside mover, or at least from a volume perspective as well, down almost 1% on L'Oreal shares, which, Anna, again, I think brings me right back to keeping one eye on France, one eye on what the Prime Minister Bayrou has to say when it comes to the balancing the books and balancing the French budget as well. Lots to digest. We're going to do that throughout the rest of the show and in the programming ahead. In the meantime, let's take a broader picture of where equities are supposed to go. Louise Dudley, Global Equities Portfolio Manager at Federated Hermes, joins the table this morning. Louise, pleasure to have you, as always. We're starting to get some tariff warnings. We're starting to get some hits to the bottom line. Volvo Cars is one example. We're seeing it in several others as well. This is a first 3 months after Liberation Day. Is this the canary in the coal mine?
I think, we've still got a lot of companies who are thinking that a lot of it is still not happening for them, that, they're still waiting for those prices to move. They're thinking about how they can readjust their supply chains, how they can change and really reinvigorate, their overall sourcing to ensure that they're not really passing on the price increases to their customers and also pushing their supply chains to do less. So I think at the moment we're obviously seeing inflation kind of continuing to teeter along. And so to a certain extent that gives us an indication that things aren't really hitting yet and that there's still more to come in H2, and certainly that H2 weakness is really where we expect it to come through.
How much cushion do European companies have to absorb some of those pressures? If we're not seeing it show up in margin compression, for example, is that showing up in, eating into cash reserves, for example? How much cushion is there?
Yeah, I think it is that, but I think there's also maybe some room on margin as well. I think, kind of year to date and over the last couple of years, we've had obviously wages going up and that's been compressing, but I think they've also been passing on costs, as I say, down the supply chain. But I think one of the key things, particularly for UK companies, is that wage growth that's been really hurting. And so that's really something that they're looking to try and offset, maybe through innovation, through AI, hiring freezes and things like that.
Louise, good morning. You mentioned they're UK companies. I've just broadened the UK lens a little bit. We're going to be having a few conversations today running up to the Mansion House speech by the Chancellor, no doubt digesting it tomorrow during the show as well. I mean, there could be, our reporting suggests there could be some news flow around mortgages. There could be something around financial services regulation, perhaps no change on cash ISAs because there was some pushback there. What matters to you, do you think, Louise, in terms of where this story goes?
So I think it's about business confidence. That deregulation story is something obviously the city is always happy to hear as a message, but also that confidence. We saw a bit of a wobble last week. That business confidence, how they're going to be able to fund, any potential fiscal deficit and things like that is really what people are looking to really be reassured on, as well as maybe perhaps additional spending going into some of those growth areas such as AI and healthcare.
Yeah, where do you see the pressure points at the moment? We had some data on the labour market that was a little weaker yesterday, but we had some retail sales data, perhaps helped by the weather, that was a little more positive. So as far as the UK narrative goes right now, how do you see things developing from here?
I think, as you say, it's quite mixed. I think, the services sector continues to do quite well, but maybe more on the manufacturing side, it's a bit weaker. So at the moment, really, you have to be quite specific. Certainly within the healthcare side, I think that's probably the area that we're most optimistic, where companies can really benefit and maybe don't have some of the wage pressures that other companies are seeing. And maybe from a tariff perspective are also globally diversified and can also rejig that to kind of maximise and be most efficient on that.
There's a big question, of course, ahead of this Mansion House speech and arguably in France as well with Prime Minister Bayrou about how that shows up in the bond market. What is the ripple effect between the volatility we have seen tiny iterations of in the bond market into the equity market?
So I think it depends. I think, at the moment with kind of valuations where they are, I think, people are looking for where that next leg of growth. And obviously that's more of an equity story And I think obviously also on a tariff perspective, because where we are in the year as well, people are looking to be reassured about full-year guidance and kind of looking into 2026 as well. So maybe less of a bond story, more about that equity, that growth. Can the UK continue to deliver what recently has been kind of pretty good relative to the rest of Europe?
I'm going to put my Guy Johnson hat on and talk about the currency market as well, because he loves to say, I think he talked to some company that was talking about a potential euro at 125 and how a lot of European companies are or are not hedging that possibility. We just had our colleague Mark Cudmore talk about a potential swing back or retracement in that level. Is that something Stock 600 companies are prepared for?
I think it's hard, actually, something we were discussing on the desk yesterday. You know, how do companies manage these kind of medium-term, longer-term contracts? Who takes on that risk? You know, Treasury departments within companies are pretty good at doing that. And I think these days, you know, actually we see kind of generally companies get it right in terms of hedging. So taking on the right amount of risk and therefore also kind of balancing the cyclicality perhaps of their earnings because of that.
Talk to us about the earnings story then that we're still to hear about. We're gearing up for bank earnings out of the United States. Mark Cudmore, our colleague, was saying there's quite a low bar for the earnings stories to impress this time around, and there does seem to have been quite a lot of downgrading of estimates. And you sort of put that alongside the fact that demand was pulled forward into the start of the year. I wonder what narrative you're expecting to get from the earnings season.
Yeah, so I think particularly on banks, I think we're coming into kind of earnings with banks being quite kind of relatively stable from a valuation perspective. They've done quite well in kind of last week or so, but very much a beneficiary of the deregulation and, you know, potential kind of tax expectations that are going to come in through the end of the year. So I think that's definitely a sector that we're quite kind of bullish around, that we expect some of those US banks to be really capitalising on some of those areas, also doing quite well through the volatility and also benefiting from kind of some of the M&A activity that's also kind of coming through as well. That's been quite a good year so far for them.
Yeah, and I suppose we could see deregulation then in financial services in the United States under a Trump administration and here in the UK for probably very different reasons, but under this Labour government, trying to change things in terms of the post-GFC regulatory environment.
Yeah, I think perhaps also the UK may be looking across to the US, you know, as the biggest market and looking to ensure that they're remaining competitive. For banks and within healthcare as well, it's so important that they think about that global landscape. Where do companies want to do business? How are they helping businesses do that better?
When we talk about, I'm going to bring right back to where we started on the tariff read-through, if I can here. 30% is a scary number. 70% is a scary number. But 30% doesn't feel as cost prohibitive, obviously, as 70%. There is a narrative right now in this market that because of the complexities of supply chains, that 30% will not in its entirety get passed on to the consumer, and therefore 30% is not a scary number. What is the line in that sand where you would say, actually, that's going to actively eat into demand for some of these companies?
So I think it depends on the industry a lot. It depends on the types of companies, the types of products that they're selling. But I don't think people are thinking 30% is going to be the number. And I think maybe the rebound that we saw yesterday where people are like, OK, 30% is the big number, but then immediately he's kind of softening it with, oh, but this is just a negotiation. So, yeah, I think it's, and to a certain extent, we've seen this before, you know, that it's a negotiation tactic. He comes out with a big number, it then gets softened. So I know from, previously when tariffs have come in, we have seen price increases coming through. Trump's obviously putting a lot of pressure on companies not to pass that on to consumers, but I think we can expect a certain percentage going on. But maybe that's a 10% that gets split out across the supply chain.
Yeah, there's a temptation, Louise, to think, OK, well, now we've got August the 1st, that's the date, then we'll know a lot more about tariffs. I wonder if we'll ever know the full picture around tariffs, because sort of constructive ambiguity around tariffs seems to be part of the playbook. And there are lots of sectoral tariffs that have been investigated or are being investigated, but certainly not fully announced and implemented yet.
Yeah, and I think also particularly when it comes to kind of critical minerals, which has been a big kind of negotiation point, those prices are continuing to be volatile. They're going to continue to affect kind of supply and demand going forward. So definitely it doesn't feel like it's ever going to be a done deal. It's going to be an ongoing playbook, as you said, in terms of that negotiation for years to come. OK,
Louise, thank you very much. Thanks for joining us this morning. Louise Dudley, Global Equities Portfolio Manager at Federated Hermes. A quick check on the core six. Guy Johnson is not here, but his pick of 6 stocks to watch here in Europe is still here. We have ASML up by 2.1%. Clearly, the temptation is to link that to the Nvidia story, and perhaps that is exactly right. Nvidia able, it says, to export its H20 chips to China. They were designed for China, had to be pulled back, though, on exports there because of the changing regulations in April. That's the biggest mover, really, and the most interesting one here. Schneider Electric up by 0.7%. Interesting focus on electrification and data centres later on in the day over in the United States, perhaps. Nestle and Novo Nordisk both moving to the downside. Now let's get a check on some of the individual stocks that are moving here in Europe with a deeper dive into some of those. Here's Chloe Melly. Chloe, good morning.
Good morning. Let's start with Ericsson this morning, which is down 4.4% almost. Ericsson reported earnings this morning, and it seems that the market is not too impressed even by its profit-beating expectations. The profit-beat expectations on the back of a strong 5G market, but the company did flag some weakness related to tariffs. So that might be the reaction there, which is sending the shares down 4% this morning. Now, moving on to another part of the tech industry, the semiconductor industry. We've got a couple of rating cuts from Citi this morning on Soitec and Siltronic. So those are not necessarily household names, but they are very important key suppliers to the semiconductor industry. They provide wafers. And Citi said that there was continued weakness there, high inventories and pressure on end markets. And that is sending those two stocks down 2.5% and 2.7% this morning. Moving on to UK retail. So retail sales jumped in June. That's on the back of really good weather in June in the UK, which led people to go and buy electric fans and go and buy leisure equipment, etc. And that was really a sign that the UK economy was rebounding a little bit after contractions in April and in May. And there's a little bit of activity this morning on the back of that from UK retailers. Sainsbury's seems to be a little bit up. Tesco and Next, however, it's a tiny bit down, so it seems to be a little bit unclear what the impact is on those retail sales. And then finally, we have got Orsted. So Orsted is up almost 6% this morning. It is now it's been rated overweight at Morgan Stanley. Morgan Stanley said that the wind developer from Denmark was worth a fresh look. So that is really sending the shares higher this morning.
I think I'm ready to order a windmill myself from Orsted for this heat wave. Chloe Melly from our equities team, we thank you so much. Coming up on the program, we're going to dive into the banking sector. Wall Street's largest lenders begin reporting earnings today, with JP Morgan and Citigroup first on the list. We're going to dive into what we can expect from the U.S. lenders next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. 17 minutes into our European session, and the gains are modest, to say the least, here in European equity markets, and non-existent in some cases. US futures, though, pointing a little bit higher. Interesting news lines around Nvidia. They think that the US administration is going to allow them to send H20 chips into China once again. So as a result of that, we see Nasdaq futures up by around 0.5%. Let's talk about the auto sector, though, because we've had some news flow surrounding that here in Europe. European autos in focus. The sector is feeling the heat after US President Donald Trump dialed up trade tensions. Volvo Cars says it's taken a $1.2 billion impairment charge because of delays to some of its electric models and, crucially, the rising cost of tariffs. For more, let's bring in Bloomberg's Global Autos editor, Craig Trudell, who has details on this and the wider autos narrative this morning. Craig, good morning. So $1.2 billion in the case of Volvo Cars. They're putting this down to something and tariffs, but tariffs is the thing that sticks in your mind. Is this the first of a few?
Yeah, I do think that there are some self-inflicted wounds sort of mixed in here that makes this a little bit messy, but absolutely I would expect this to be the first in a trend for this earnings season. People have talked a lot about the so-called taco trade and Trump chickening out. One area where he has not done that has been in auto tariffs, and I'm not particularly surprised by that, given the fact that whenever he has talked about trade, cars has been, an industry that's been on the sort of tip of his tongue as, a way in which the U.S., in his eyes, has not been on equal footing with the rest of the world in terms of of trade with other countries. He wants more cars that are sold in America to be built there.
Craig, can you just put the number into some context for us? Because when we saw the likes of Ford or GM, for example, the numbers were similar in terms, and that was just for Canada and Mexico. That wasn't for the rest of the world. How much is $1.2 billion in the context of the industry?
Yeah, I would say in the context of Volvo Car, it's a pretty big number because it's a much smaller player in the U.S. than GM or Ford are. And the numbers that, GM talked about in particular, I mean, $5 billion as a rough impact on their profit for this year was really substantial, right? And so I think those headlines have sort of faded a little bit, despite the fact that they were so big. And we've seen maybe not necessarily a realization of sort of the worst case scenarios of car prices left and right going up $5,000, $10,000. I think we've seen a reluctance on the part of manufacturers to sort of be the first to blink and lose share, because that's what's going to happen when you jack up your prices and your competition doesn't.
Talk to us a little bit about why we're seeing a positive reaction, though. I mean, we're talking about these scary numbers, and Volvo cars are higher by 2%. Is that just a European summer, or is there something more to it?
I think the shares did take a hit last night, and so maybe a little bit of relief this morning. I think it's also been pretty well known that this company has had serious issues with some of its platforms, and so those self-inflicted wounds that I mentioned earlier come as no surprise to investors who follow this company closely. In terms of the tariff impact, it's really remarkable to see how sort of resilient these companies have been, even as they've really taken it on the chin with these tariffs. You've not necessarily seen just an absolute drubbing for this sector. I guess, the counter argument you could make there is they were already pretty depressed going into this whole saga.
Yeah, so they were really depressed. And as you point out, yes, this broke half an hour before the close, didn't it, yesterday?
Right.
So we did have a chance to factor that in. So that's a point well made. Let me ask you about Japan, but this is a very related topic. Just last week, we were talking about Japanese car makers announcing their export prices to the United States. They were cutting them by 20%. And this really raised all kinds of questions for us, thinking about pass-through of tariffs and higher prices to consumers. It raises the question, are consumers going to pay more for cars, or is it going to be the companies take it on the margin?
Yeah, I think any sort of strategy that's being that can be pursued at this point to try and hold off from price increases, because you not only have some manufacturers sort of holding the line, you even have some of the players in the U.S. like a Ford that for those vehicles that they make in the U.S. They're really sort of leveraging them as a sort of cudgel against their competitors. So you saw Ford come out with employee pricing. So not only would you increase your prices relative to competition that are theoretically keeping them steady, Ford's actually going in the other direction, and that is going to sort of make its competitors, including the Japanese, reluctant to raise prices, because it would mean a significant hit to their sales. I also think we've not necessarily seen some of these price increases for the obvious reason of a lot of these manufacturers tried to export as many cars as they could into the U.S. before these tariffs hit. And so, how many cars are stuck at ports, and are we, sort of not necessarily feeling the full brunt of this? I think we'll hear more from executives about that in the weeks to come.
All right, Bloomberg's global auto editor Craig Trudell walking us through some of those main stories. We thank you so much. Let's go from the auto sector to the banking sector. Wall Street's 6 biggest banks kick off earnings this week, with JP Morgan and Citigroup set to report later this morning. Bloomberg's Charlie Wells is here with a preview. Charlie.
Kriti, good morning. Well, look, analysts really are very optimistic for this sector. I got to show you guys a chart that I really just cannot unsee. And this is that KBW Bank Index beating the NASDAQ year to date, just speaking to the optimism that a lot of investors have on the back of that Trump-era deregulation, a lot of these changes to capital rules. Now, as far as earnings, what we're expecting is to see some strength coming from the trading side. A lot of the volatility that we've seen in this quarter has boosted some of these trading desks. If we take a look at some of the results, some of the revenue coming coming in from those trading desks. We're seeing on that fixed side, Citigroup really showing some leadership there, expected to show that leadership. And on the Goldman Sachs side, looking at some leadership on the equities trading side. So volatility boosting trading. Net interest income also is expected to bring in billions for some of America's largest banks. Now, this is an important revenue metric, one of the most important for a number of these banks, holding tight in this higher for longer environment. But I've got to say, if we think about the investment banking picture, that's something where there's expected to be more of a mixed bag, as a lot of this uncertainty has been bad for deal making.
So uncertainty bad for deal making, but volatility can be good for trading. And we've seen some of these share prices touching records in the sector, Charlie. What do the results, how do the results rub up against the share price performance?
Yeah, Anna, I got to show a lot of this green on the screen year to date here. All of these major banks that are going to be reporting this week up significantly this year, but do not let that mask some of the other troubles that might be out there looming in the economy. That is the word from some of these Wall Street analysts. I want to bring up some of their recent commentary that shows this divide that we're seeing. You've got this really bullish take from the likes of, say, Mike Mayo at Wells Fargo, talking about how as long as there's not a recession, these bank stocks really have room to run. Giddy up is a phrase he used a few weeks ago. Thinking about Saul Martinez, though, at HSBC, this is that more cautious take, talking about how some of those macro risks are just not priced in to a lot of the optimism that we have seen here. And if you want to take a look at one individual stock, JP Morgan, we can look at how this is playing out for some of these individual names. So you see 53% buys, but more cautious takes from other analysts.
Well, speaking of caution, Charlie, what gets in the way? What's the red flag here?
I mean, Kriti, look, we've got a lot of these trade tensions, concerns that could spill over into the performance for these banks, changing the atmosphere that they're operating in. But also, if you take a look at some of the regional banks, there's less optimism. They really are lagging in the United States relative to those national peers. And I think this could speak to this issue that, sure, you've got a lot of performance, a lot of solid performance coming in from these markets businesses. But is that masking some consumer weakness? Is that masking some retail? Is that masking some residential real estate weakness, commercial real estate weakness that a lot of these regional banks are more exposed to? So I think as we hear these earnings come out, as we hear these executives talk, this is a framework to view these earnings through.
Bloomberg's Charlie Wells walking us through what to watch for those bank earnings. We thank you so much. Anna.
Yep, coming up on the programme, we will look ahead to the UK Chancellor's annual Mansion House speech with Nigel Wilson, chairman of Canary Wharf Group. That conversation coming up next. A lot to discuss when it comes to the Mansion House agenda, fiscal sustainability, fiscal commitments on behalf of the Chancellor. That's all going to be really crucially watched given the volatility we saw in markets around her appearance in the Commons not that long ago. And this is the first time that she'll be really addressing the city and addressing markets since then. Home ownership, mortgage schemes, financial services regulation. All of that will be in focus. How to get more money into UK stocks as well. How much should we worry about the UK IPO market? All of that in conversation next. This is Bloomberg.
Welcome back to the opening trade. About 30 minutes into today's session. Green on the screen across the continent, but only higher by 0.2% when you look at Stock 600. Some volatility there, some slight changes, but again, it's a risk-on day, but not by an enormous amount. I think that's the best way to phrase it here. One of the main things we're keeping an eye on, of course, is a speech right here in London from UK Chancellor Rachel Reeves, her annual speech to London's financial industry later at Mansion House. It marks a key moment for the sector, but also for the Chancellor herself after the recent market jitters over her future. Bloomberg's Marwana Kaniam is all over the story and joins us now. What is the city looking for in this speech?
Well, they're looking for quite a few things. I think overall it's going to be a commitment to boosting the City of London and, in particular, getting investment in the UK. So one of the things that I think people are expecting is some reforms to the tax on share sales and also this sort of one-stop shop concierge service to help companies invest in the UK. I think those are two big things that we'll be watching for. There's also a few other things that the payment system regulator being scrapped, looking for more details on that. And also some changes to the ring fencing rules as well on customer retail deposits and things like that. So those are a few of the key measures that we'll be watching for. I think also the city is going to be wary of any signs of a wealth tax, which obviously we've been discussing in recent days, and also for more details on changes to the pension system, the auto-enrollment system, and also, as has already been announced, changes to the way in which firms are expected to invest, particularly towards UK assets.
OK, so lots of things that the financial services sector specifically is going to be tuning in for then, Morwenna. What about the broader pitch? Because as a Labour Chancellor, no doubt Rachel Reeves will be wanting to join the dots between the role that financial services plays in the wider economy.
Absolutely. And in fact, today we're expecting her to make a speech actually up in Leeds before this, where she's expected to detail some changes to make it easier for people to get mortgages, particularly first-time buyers, people on lower incomes. And there is expected to be a new guarantee scheme announced. So I think that's something that she's really going to be sort of trying to pitch to boosting the broader economy as opposed to just the financial services industry.
OK, Morwenna, thank you very much. Morwenna Conningham with the latest on what we're expecting to hear from the Chancellor later today. Let's get an industry perspective. Nigel Wilson joins us, chairman of Canary Wharf Group and regular visitor to the programme, to Bloomberg TV. Thank you very much, Nigel, for coming to talk to us. So we just heard Morwenna talking through a host of topics that could be on the agenda then for the Chancellor a little bit later on today. Taking a step back, what do you think it's important for her to communicate today?
I think the key important point which you mentioned is actually how do we boost investment to boost growth, and that's what we failed to deliver so far. We have a very good savings culture in the UK, but we don't have an investment culture, and we have to transfer from being a savings country into an investment country. And that's going to upset some people as they feel safe in saving, but there is not enough advice and support for investment.
Yeah.
And so you need all of the regulators to join up and say, actually, we're going to be a growth economy, we're going to be investment-led around that. We have to make changes. So I see the FCA putting a hand up and saying, actually, we're going to help on advice. Actually, there's a massive advice gap in the UK. I think Nichols is going to be supportive because he's in his second term in office, so he's very much more confident than his first term, and actually give people advice so that they actually can be confident in investing and not just savings.
Yeah.
We desperately need reform of the pension industry, of the ISA industry. I think she's a bit nervous about doing that right now. I think what would be helpful is if Andrew Bailey puts his hands up and said, actually, the economy's more resilient than we thought, but there's some early signs, some early warning indicators that we're moving off trend growth. We need a boost to trend growth, so actually interest rates are going to come down and actually signal much more positively and less nuanced about doing that going forward.
OK, yeah, maybe he's been trying that over the last 24 hours. There was some talk, wasn't there, from him about how rates will still come down, but maybe you want to see a little bit more guidance on that front. Thinking about then how we get more of an investment culture, not just the savings culture. I mean, something like stopping everybody just piling into cash ISAs, is that the kind of thing that you would have liked to see? Because that was talked about, but then perhaps shelved because of objections from some parts of financial services.
One of my big personal failures has been to try to stop cash ISAs growing as quickly. And there's over £400 billion in cash ISAs now, and there's 40, 50, 60 billion gone in, or likely to go in this year. That's just too much into savings and not enough into growth equity. And we have a lot of very undervalued companies in the UK, and people should be shifting their money into those undervalued companies rather than letting them be acquired going forward. And that's a sensible thing from a macroeconomic viewpoint to do.
You talked about, I want to hit that twofold. Let's start off with the savings bit that you mentioned specifically. One of the things that Morwenna had mentioned as something that they're looking to watch in this speech is kind of the ring fencing rules around some of those savings schemes and specifically the retail banks as well. There's a question if there is a change to that plan coming forward. What might that look like if something like that were to manifest?
I think the two parts of that. I think the default funds in DC need to have a bigger allocation to private assets.
In defined contribution pensions.
Defined contribution pension schemes. You know, this is a £800 billion industry with a tiny investment in private assets. And the private markets are growing tremendously, and there's a huge need for infrastructure investments. In the UK, just picking up this point, we're brilliant at startups. 6,000 new startups every year, funded by the EIS, SES and VCT. But after that, we just neglect policy and regulation and tax. And so we're short on Series A, Series B. So all of these growth companies, except the best get funded by international markets and not by domestic markets. We have to change that going forward. So we not only have an investment culture, but a growth culture. We're really letting young people and entrepreneurs know that they're going to be supported through the investment system in the UK. And that can be done through the DC pension scheme. DB pension schemes don't have to hold no equity whatsoever. When you think that a lot of people are going to live for 20, 30, 35 years in a DB world, they can afford to have some of their assets, particularly where schemes are in surplus or that they can hold more equity in that. And that's another reform that could happen. And the mix between cash and gilts and equity within the ISA schemes is just wrong. It's too heavily dependent on cash and gilts, and we need it much more skewed towards its original intention, which is to invest in growth equities, the PEP schemes of yesteryear. But we've had a number of chancellors who started to think about doing that. In fact, Jeremy was very close to making some changes. This is a time when the Chancellor's got to say, actually, we're changing the culture. We're moving from a savings culture to an investment culture. And at the same time, we're going to support young people who want to get on the housing market, because the housing market at the moment, nowhere near hitting the targets that they set, the 300,000 houses per year, just for England, and we're miles behind that target.
Well, you highlight this investment culture, but it feels like what you're saying is specifically the equity piece of this as well. One of the key criticisms of that from, I say, any foreign investor is that you get taxed at every single ability to even get in on that, whether it's through a pension scheme or whether it's even as a retail investor, for example. Do you think Rachel Reeves has any incentive to budge on that?
She's got an incentive to budge on that, but she's constrained. She's constrained. I think not, personally, because it's I think she'll have it as a budget issue. Otherwise, people are going to model what are the changes and what are the impact and what do they do for the fiscal rules going forward. And she wants stability. You know, the economy is quite resilient, but not growing. She's got some stability as a consequence of that. But there's some very punchy numbers in the OBR forecasts going forward. And a lot of the items that people want change make a huge contribution. I mean, if you just think of property taxes, at the moment, they're about £12.6 billion. In the forecast for 2029-30, they double that. That's a huge delta. If you start changing the tax on those particular items, you'll have an even bigger hole in your financial forecasts going forward. So there's a need to create more dynamism in the economy. There's a need for more investment. There's a need to massively change the culture. I think Andrew and Nicole and Sam Woods as well are much more experienced now themselves. They've been in the job a long period of time. They can see what's happening in the real economy, and they can be supportive to what Rachel really wants to do to help drive economic growth.
So so these are the regulators that sort of accompany her at the PRA and other places. You talk about dynamism and wanting this more dynamic culture around the UK economy, Nigel. I wonder if it matters to you whether these are listed businesses or not, because we talk a lot about the trouble that the UK has in attracting IPOs at the moment. And is there something inherently much better about having a stronger listed economy, or does it not matter if it's held by private equity or in private hands?
It doesn't matter in big picture terms. I think we've underperformed in attracting new listed companies in here, but we've got lots of unlisted ones and private ones which are doing incredibly well. Let's celebrate that.
Right. And actually, so if we focus on the listing rules, is that too much focus there?
It's too much focus on something that's actually not going to be difficult to turn around in the short term. Whereas actually we've got loads of great private companies that are growing. We've got all these growth companies which are non-listed. They don't have to be listed quickly to get access to capital. That model has changed, and the fastest growing markets in the world are the private markets. Let's go with that, because we have a great private equity business in the UK. We have a very good VC business, but they need to they need to be bigger and more successful. And therefore, if you spend all your time worrying about the fact that we're not getting enough listing, you're not spending enough time on what could be the real drivers of growth in the UK. We need masses of private capital to go into rebuilding our infrastructure and supporting our initiatives on transport and housing and everything else. Let's not be embarrassed by the fact that this isn't taking place through public companies, but let's make it happen anyway through private companies.
But Nigel, the point that you're making is raising the bar for taking on more risk. Private markets, although juicy right now, to your point, are hard to navigate, demand a higher risk premium than listed companies do on the stock exchange. They're not as accessible to a retail audience that is looking to either grow a pension or is looking to even have, a retail trading account with a Vanguard or a Fidelity or et cetera. Doesn't the emphasis on private markets actually raise the bar to take on more risk? No.
I mean, risk is wrongly defined. Everybody focuses on risk on 1 year VAR. The reason 1 year VAR is used is that's when I was a young man, that's what the maths and the computational skills allowed you to do, is to do analysis on that. If you're making a 10 or 20-year investment decision, you should be looking at 10 and 20-year VAR, and you have a totally different perception of what is risk over that period. So I don't agree with your premise.
A 10 or 20-year investment horizon, the way you make that, and the way private markets work, is because you can invest in scale. How do you make that applicable to someone who is not a millionaire?
Yeah, that's why the DC reform is required, actually, and for 10% of the assets to be in private assets. At the moment, and that comes through the default fund. And most people, actually 90% of people, just tick the box which says, I'll have the default fund. And you're taking away the risk for them by making the asset allocation 90-10. And 10% of your investments in private assets over the next 10 years is a good bet, not a bad bet, because it's a 10-year horizon that you're making that difference. A lot of our industries and growth industries are going to emerge over that period. And most of those businesses are private businesses at the moment. The best of them are going to be 100% funded by international equity if we don't do it in the UK.
Okay, Nigel, thinking about risk, and one of the lines we've been trailing this morning is around home ownership. We've talked a little about their ambitions, the government's ambitions around home ownership, and there could be another mortgage scheme coming here. When you hear about mortgage schemes and helping people to buy property in the UK, do you think, well, that's great, that helps people get on the housing ladder, or do you think we're just increasingly addicted in an unaffordable housing market to these kinds of government schemes?
No, we have to boost supply in the UK. The government has a sensible target, the 1.5 million, the 300,000 a year, but unless it stimulates the demand at the same time, we're not going to have adequate supply. But at the same time, they can work on affordable and work on build-to-rent and social housing, and they need a comprehensive housing strategy. And at the moment, we don't have that. In part because actually, even though they've improved the planning system, they've introduced renters' rights, they've got the building safety regulation, which has now got massive problems in being implemented, and we're looking at whether we should abolish upward-only rent reviews. And all of those things act as a constraint on growth. And we've got to stop doing this, is actually saying we're going for growth and then put all these barriers in the way from delivering that growth.
OK, thank you very much, Nigel. Really good to speak to you. Thank you so much for coming in. Nigel Wilson, chairman of the Canary Wharf Group. Great to get his perspective. Another perspective later on in programming. Alistair King, the Lord Mayor of the City of London, will be on the pulse later this morning. That is, of course, still ahead of the Chancellor's Mansion House speech later on this evening, Kriti.
Absolutely. Coming up on the programme, Donald Trump not happy with Russia's President Vladimir Putin, or what the U.S. president is threatening to do if a ceasefire is not reached in Ukraine. That conversation next. This is Bloomberg. Welcome back to the opening trade. 48 minutes into today's session. Green on the screen across the board here. Outperformers, of course, in the DAX higher by 0.3%. But your outperformer very much is those tech stocks. The read-through from the Nvidia story saying they can now export H20 chips to China, certainly having impact on the European tech sector as well. Let's stick with some of the policy coming out of Washington. This time, certainly having an effect on Europe as well. U.S. President Donald Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Now, Trump said the levies would come in the form of secondary tariffs.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Joining us now is Tony Halpin, who leads our Russian economy and government coverage. Tony, Donald Trump ratcheting up the pressure on President Vladimir Putin. Can you just walk us through the latest commentary from the White House?
Yes, I mean, Trump clearly expressed disappointment with Putin. He said, I think at one point that he thought 4 times there might have been a deal on the table that Putin would accept, but it didn't happen. I'm not sure, by the way, that the Kremlin's viewpoint is the same. And from a Russian perspective, actually, this may be less of a threat than a window. They see that as 50 days in which action from Trump is deferred, and 50 days on the battlefield, of course, is a very long time, particularly in the summer fighting season. So in some measure, it may be even a relief for the Kremlin that Trump has put off this threat until 50 days from now, but clearly it's looming on the horizon and they will have to take account of it.
Yes, and where do things head next then here, Tony? Trump is also keen to emphasise that the US isn't paying for weapons for Ukraine. So he's also been saying that weapons will be sent, but it's going to be done via NATO, and he thinks the money is coming from Europe. What's the story there?
Yeah, I mean, the key point for Trump is that the US won't pay for these weapons, that Europeans will pay for them, and Ukraine potentially also will pay for them, and they'll be provided to Ukraine. And that's important for Ukraine because they've been very nervous in recent weeks that the allocations made by the previous Biden administration was due to run out sometime in this summer, and they weren't clear that they were going to get a fresh supply from the Trump administration, which hasn't allocated any funding for it. So now they know at least that they can get weapons. It's a question now for the Europeans how those are paid for, but from Ukraine's point of view, it will allow them to defend themselves against Russian attacks, which in recent weeks have intensified.
Tony, thank you very much. Tony Halpin, who leads our Russia economy and government coverage. Thank you very much for joining us. Yeah, and really interesting. He gives the Russian perspective there. And it seems to be that's what the oil price was looking at yesterday when we heard this conversation around tariffs coming to Russia. And yet the oil price went lower on action deferred. Let us talk about what else is on the agenda then for today. It's actually quite a busy day. We've got US CPI to round things out. But we start with Euro area industrial production. That's at 10 a.m. UK time. I think we get ZEW numbers out of Germany as well around that time. We get US bank earnings, JP Morgan, Wells Fargo, Citi and the rest. So Charlie Wells setting us up nicely for that conversation a little bit earlier on. And then, as we've mentioned, Kriti, the US CPI number, Mansion House, that speech by Reeves and also Bailey. But the French budget also on our radar as something that we're watching.
It's a fascinating one because we haven't seen much reaction in French assets just yet, but there's a lot of doomsday in terms of analyst notes, in terms of the reporting around this, the idea that Emmanuel Macron is going very forcefully into the idea of a defense ramp-up, talking about things like utilizing the anti-coercion tool in reference to retaliatory tariffs into the United States, and yet doing it at a pace and at a timeline that his budget may not be able to endure. And that's where Prime Minister Bayrou's comments are going to come in handy today.
It is interesting what Macron has been saying around the tariff story, though, because you're not sure he's speaking for the rest of Europe, are you? Right. Because it sort of sits in contrast with what we were hearing from Suzanne, our bureau chief over in Brussels, who was saying, look, we're not going to see much retaliation from Europe right now. What they're focused on is trying to get a deal done by that August 1st deadline, and viewing that as still a possibility rather than Macron's line, which is all this sort of tough talk on retaliation.
Absolutely. But if it comes down to the same fears we had last summer, which is that this deficit is only growing, it's actually not getting better in terms of that, why is the bond market not reacting? Valerie Titel, I think, has all of our answers for us and joins us now. Val, should the bond market be reacting to this, or are there other things that are higher up on the worry list?
Well, look, I mean, fiscal concerns are clearly a concern, not just in Europe. We also are seeing them in Asia. We're seeing them in the U.S. But it's funny, they seem to arise at one sharp, specific moment, like we saw with the U.K., with the Chancellor Rachel Reeves' tears in Parliament, igniting this fiscal dominance moment. So it does seem to need something to kick it off, you know, whether that announcement of the extra defense spending from France, maybe it just wasn't enough to alight concerns around, again, we're seeing a decent rally across fixed income this morning. Unsure the reason why, but it does seem like things are pretty settled in French OATs ahead of this budget decision.
Right. So if the global bond market's focus is not on French overspend, it's on the long end of the Japanese market. It's on US Treasuries and the long end there. Is that the global focus at this point? And we're heading into the CPI data, but important to think about where the market is in its thinking, I suppose.
You know, it's very interesting to see, for instance, NASDAQ futures at all-time highs while we have the 30-year yield flirting with 5% again. It does seem to be this reoccurring theme that we need kind of a blow-up in the bond market to then dent the equity market rally. And at the moment, you know, we're maybe flirting with levels where we start to see that kind of price action, but we're not there yet. But we could get it after U.S. CPI today. I think the real worry for the bond market and for the equity market, Anna, is a print that shows not just a tariff pass-through into components, which we have our eye on, but tariff pass-through into a broader basket of core CPI goods, which could maybe, I guess, lead investors and lead the market to believe that retailers are getting comfortable passing on prices to consumers, passing on these price hikes, even though it might be something that's not directly exposed to these immediate tariffs.
They did it so recently is a thing I keep coming back to, a thought I keep coming back to. You know, the post-COVID, that push up in prices that we saw in many developed markets, retailers, consumer goods companies have that in their very recent experience. You know, we faced higher costs, so we passed it on to consumers and they took it and we were able to command higher prices. I just wonder whether that muscle memory is going to kick in at some point.
Yeah, but no, in the last CPI print in last month, the components we were worried about, such as electronics, apparel, furniture, even new cars, saw month-on-month deflation. So we have not yet really seen evidence of prices coming through. The worry is that we could all of a sudden see it in 1 month. Whether the print today is going to be too early to tell, you know, we'll have to see. It's very unlikely that this will have a shift on Fed pricing when it comes to July.
Yeah.
I think most market participants are focused on the September meeting instead, where we will get another CPI print and more labor market data for the Fed to make a final decision on whether to reduce interest rates in September.
Got an exciting 24 hours ahead of us. Bloomberg's Ari Titel walking us through some of the key things to watch, specifically in that CPI report coming out about 8:30 a.m. New York time, 1:30 p.m. right here in the UK. But, of course, France also on our minds because we do have that conversation, or I should say that budget speech from Prime Minister Bayrou. We have some great conversations right off the back of that. Our exclusive conversation tomorrow with Eric Lombard, the French finance minister, right here on the opening trade. Maybe we could talk to him a little bit about the proposals that Prime Minister Bayrou has or is planning on putting forward, how they're going to plug that hole in the deficit and still steer the French economy in the right direction. But in a little over an hour, Benjamin Haddad will be joining Bloomberg Television as well. Stick with us. This is Bloomberg.